In the vast landscape of business finance, companies face a critical choice between two paths: debt financing and equity financing. This decision shapes a company's financial structure and future. Debt financing involves borrowing money from external sources like banks, with a promise to repay the principal plus interest. It offers predictability. Companies know exactly how much they need to repay and when. Interest payments are often tax-deductible, reducing the net cost of borrowing. Companies retain full control, as lenders have no ownership stake. However, debt creates fixed financial obligations that must be repaid regardless of the company's situation. This can strain cash flow, especially during downturns. Over-leveraging with too much debt can threaten a company's stability. Equity financing raises capital by selling shares of company ownership to investors. This shares both risk and reward with investors. It brings in not just money, but often valuable expertise and connections. There's no obligation to repay the funds. The trade-off is dilution of ownership and control. Companies must consider the perspectives of investors who now have a say in the company's direction. Future profits must be shared with shareholders. Choosing the right path. Selecting between debt and equity financing requires analyzing several factors: the company's current financial health, risk tolerance, strategic objectives, cost of capital, impact on cash flow, tax implications, and stage of development. Startups with high growth potential but little collateral may find equity financing more suitable. Established companies with steady cash flows often prefer debt financing to maintain control. Many companies use a hybrid approach, blending elements of both to create a tailored financing strategy. This might mean taking on some debt for immediate needs, while also issuing shares to fund long-term plans. The choice shapes everything from capital structure and risk profile to control dynamics. It requires careful consideration, strategic foresight, and understanding of the broader financial landscape. 3 paths to capital. When raising capital, companies have 3 main options: loans, bonds, and stock offerings. Each offers a unique journey with its own terrain and rewards. Loans, the steady companion. Loans provide quick cash injections from banks or private lenders. They offer predictability, with clearly defined terms, interest rates, and repayment schedules. This makes them attractive for short-term capital needs. The downside is the obligation of regular repayments, regardless of business performance. Companies must carefully plan to ensure they can meet these fixed obligations. Bonds, tapping a wider circle. Issuing bonds allows companies to borrow from a broader pool of investors. Bonds are essentially IOUs, promising to repay the principal with periodic interest payments. This path often offers lower interest rates than traditional loans. However, navigating the bond market is complex. It involves credit ratings, market conditions, and convincing investors of the company's stability and growth potential. Stock offerings. Opening to the world, going public through an initial public offering, IPO, or issuing additional stock is the most transformative path. It invites investors to become part owners of the company, potentially raising significant capital. Unlike loans or bonds, there's no repayment obligation. Instead, investors receive equity and share in the company's fortunes. This can fuel major expansion and innovation. The trade-off is relinquishing some control and entering the public eye. Companies face increased scrutiny from shareholders and regulators, along with stringent disclosure requirements. Navigating the capital landscape. Choosing between loans, bonds, and stock offerings depends on various factors: company life cycle stage, financial health, growth objectives, and risk tolerance. Startups might lean towards loans for simplicity. Established companies may explore bonds or stock offerings for larger projects without repayment pressure. All paths require thorough preparation, developing solid business plans, creating financial projections, navigating legal and regulatory requirements, and clear communication with potential investors and within the company. Raising capital sets the stage for a company's next chapter. It's a journey of partnership between the company and its financiers, shaping the path to growth and success. The cost of capital, a guiding beacon. The cost of capital is a crucial metric influencing strategic decisions across the corporate landscape. It's the bridge between investment opportunities and financial resources. At its core, the cost of capital represents the minimum return a company must earn on its investments to maintain market value and satisfy stakeholders. It's the price of securing funds, whether through borrowing, issuing shares, or reinvesting earnings. This number carries the weight of expectations, risk, and potential rewards. It serves as a hurdle rate for evaluating new projects. Only ventures promising returns above the cost of capital are considered value-creating. Calculating the cost. The cost of capital is typically calculated as a weighted average of the costs of debt and equity financing, known as the weighted average cost of capital, WACC. This blends the cost of debt, interest rates on loans or bonds, and the cost of equity, expected returns for shareholders. Each component is weighted based on its proportion in the company's capital structure. Implications for decision-making. Understanding the cost of capital has far-reaching implications. It sets the bar for acceptable returns on new projects or acquisitions. Companies can optimize their mix of debt and equity to minimize their overall cost of capital. It's a key input in discounted cash flow models used to value companies and projects. It provides a benchmark for assessing whether investments are truly creating value. A rising cost of capital may signal increased perceived risk, prompting reassessment of strategies. Factors influencing the cost. Several factors can impact a company's cost of capital: market conditions and interest rates, the company's financial health and credit rating, industry risk factors, the company's growth prospects, and broader economic conditions. Companies must continually monitor these factors and adjust their strategies accordingly. Innovative financing methods. The landscape of corporate finance is evolving, with new methods emerging to complement traditional financing options. Two notable innovations are crowdfunding and initial coin offerings. Crowdfunding. The power of the crowd. Crowdfunding harnesses the collective power of many small investors to fund projects or businesses. It democratizes the investment process, allowing companies to raise capital directly from supporters. Key advantages include access to a wide pool of potential investors, validation of product or business concept, and marketing and community building opportunities. However, it also presents challenges: potential disclosure of ideas to competitors, the need for compelling marketing to stand out, and regulatory compliance in certain jurisdictions. Initial coin offerings, ICOs, are blockchain-based funding methods where companies issue digital tokens for cryptocurrency investments, granting rights within the project's ecosystem. Benefits include rapid fundraising potential, global accessibility, and liquidity for early investors. Challenges include regulatory uncertainty, market volatility, and fraud risks. Crowdfunding and ICOs require careful consideration of legal and regulatory implications. Navigating regulatory changes. Companies must adapt to evolving regulations, including public company disclosure, private placements, and cross-border financing. Compliance efforts can lead to a competitive advantage and trust with stakeholders. ESG considerations in finance. ESG factors, such as sustainability-linked loans and social impact bonds, influence financing decisions. Integrating ESG can attract ESG-focused investors, lower capital costs, and improve reputation and risk management.